All right, guys, let's talk Disney stock. This company has been around for 100 years now, and personally, I think they'll be around 100 more. The stock price has been beaten down a bit over the last month, tracing back below $90 per share in spite of the fact that they've had some recent box office successes and that I keep hearing that the parks are breaking new records for attendance and having the massive pricing power on their ticket prices. So, I'm in a Disney stock officially. It's not a huge position yet, but I like it at these prices, and we will get into a little bit about why that is momentarily. So, when we take a quick look at their top line here, it's not that it's a massive growth business, okay? This is, of course, a very, very big company, and in order to have substantial growth, they have to either build new parks or make new acquisitions of major franchises or have many major blockbusters or gain massive amounts of subscribers on Disney Plus. And because they have so many different segments, it's hard for growth in any one of them to make it a big appearance basically on the top line here. Now, you see in 2020, their revenues took a massive dive because you couldn't really count on the parks and the cruise revenue. Now, they did gain a lot of Disney Plus subscribers during that time, but it hurt them for quite a bit during that period where they couldn't really fill up those cruise ships and those parks, and there's still costs associated with that, which really took a toll on their margins. So the thesis with Disney has pretty much been that if you get them at a cheap price and their margins return back to pre-pandemic levels, you will probably realize a pretty good gain as the market realizes that they have recovered. So you can see what happened in 2020 where their operating margins dipped negative, and this is the same, like their net income margin and free cash flow margin also went deeply negative during that time frame. But the operating margin at this point is already very close to matching their 2019 pre-pandemic operating margin. It's above 13%, and that's the same range it was in the year before COVID. So they are indeed back. However, the price is still beaten up. Why? Well, on the valuation metrics, they still look expensive, and we will get into that in a little bit. So one of the risks before we get into valuation has to do with the amount of leverage. This is a capital intensive business. However, if you look, their net cash position, or in this case, net debt position, is actually a little bit better than it was pre-pandemic. So they are actually slightly less levered from the perspective of how much cash they have compared to debt, compared with 2019. So this would mean that they've either reduced debt or increased cash. So from that perspective, it's not looking too terribly bad compared to what we're thinking of as a historical norm. With that being said, look at these valuation metrics. Like I was stating before, their operating margins are back to their pre-pandemic levels. They're about 13.5%, and 13 to 14% looks like about the range it was at back in 2019. So we're there. And their price to their operating cash flow is only 12x. Now, of course, the free cash flow is not going to look quite as attractive because of the fact that this is, at certain times, a capital-heavy business. Building a new attraction or a whole new theme park, for example, or buying a new cruise ship, these aren't cheap things. Making movies, the production costs, etc., that's not cheap. So, of course, yes, their free cash flow may not be quite as low a multiple, but look at how disconnected those two numbers are, 12 and 19 respectively, compared to the price to earnings at 96. So because of the fact that their net income is still a bit depressed in terms of the GAAP accounting, the stock still looks really, really expensive when really it's just under 20 times free cash flow. And I would think that the free cash flow will pick up a bit going forward, especially as they're making a lot of progress on Disney Plus. And after a certain point, with Disney Plus growing, they may gain some pricing power and get to a point where each additional subscriber is simply accretive to the bottom line after they overcome certain costs and get it to scale. And it looks like that is happening. They're rounding the corner there. So I would expect free cash flow to actually improve, and eventually net income should kind of catch up. But as long as they have the cash flow coming in, they can afford to, for example, pay the dividend, which they recently brought back. So speaking of the dividend, with the annual dividend of 90 cents per share, with the price being where it's at on the stock, it's just over a 1% yield. Their payout frequency on this is semi-annual, so that would be twice a year, which a little bit unusual for a lot of American companies. We traditionally pay out quarterly, with a few doing monthlies and everything. But generally speaking, most American companies, if they pay a dividend, it's quarterly. A lot of foreign companies do like the either annual or semi-annual payout, but it doesn't really make a difference at the end of the day. You're getting the same amount of yield. The buyback yield is slightly negative, and this is over the trailing 12 months, so this could be slightly in the red due to stock-based compensation if they haven't really been doing any buybacks. Now, my co-host on Cashflow Kings Live, which, by the way, you should be watching that every Saturday at 8 p.m. Eastern, told me that they were mentioning doing some buybacks here in the near future. So hopefully that will sort of turn that back around. And at these prices, with the way things I think are going for their margins, I think they probably should consider buybacks as a way to add value to shareholders. Now, people are retreating from a lot of the big tech boys into classic, stable, high moat businesses with a dividend yield. So maybe upping the yield on the dividend a little bit would possibly attract more money into the stock if interest rates go down. But I don't really care too much about the dividend. It's not the only reason I'm in the stock by any means. This is one of those coveted strong buy ratings from analysts. I don't really care what the analysts think necessarily, but even their low target is slightly above today's price with a high of 145. And this is one where, honestly, yes, Disney has achieved prices well above $100 before. So yeah, it's conceivable that if the margins really fully recover, especially the way they have been, and over the next 12 months get a little bit better, surely the market could apply a higher, assign a higher value to the company based on that margin expansion, especially if Disney Plus really comes into its own and continues to grow. So that should be a very high margin business, since they're already creating the content and all they have to do is put it on Disney Plus. And the thing I love about Disney is that all of that content sort of creates a virtuous circle. So let's get into how you would justify today's price in a traditional DCF type model. What you would have to assume to justify about a $90-ish price, which is pretty close to today's price on Disney, assume that they hit their EPS target for 2025, which this is what I think the analyst consensus is of what they'll do in 2025 is 557. I think that's pretty achievable for Disney, and you do the 10% discount rate, of course, like usual. Give them credit for their tangible book value because they do have quite a few assets. In fact, this doesn't take into account their intangible assets, meaning all the IP that they have could conceivably be worth a lot more than what the straight figures on the balance sheet really tell us, right? So we've got that. And of course, we would need some growth to happen in their bottom line, which I think something like 7.5%, dropping down to maybe 4.5%. And they could, and they're projected really to have some in the next 2 or 3 years, increases in the low to mid doubled, like 12, 13, 14%, depending on which analysts you look at and everything. So certainly they could in the next few years have higher than 7.5% growth as those margins continue to kind of creep up little by little. And then eventually it slows down to like a low to mid single digit area as they kind of just grow with the overall, GDP, or maybe slightly beat inflation or something. Now, what I love about Disney, though, is everything that they have that appeals to all the fanboys and the fandoms out there. They have this virtuous circle, right? Big Marvel series or movie comes out. Awesome. Ticket sales out the wazoo. Then they open, a Marvel or Star Wars based attraction at the park, at Disneyland, Disney World, whatever, based on that movie or series that came out, and it attracts people to their parks, and that business then gets more ticket sales. It's crazy. Then they put it on Disney Plus, and Disney Plus gets more subscribers. It's absolutely amazing, the virtuous circle that can come about whenever Disney comes out with something that's a cultural phenomenon. Think back to the days of Endgame and all that stuff with the Avengers. It was all anybody would talk about for a time. So Disney has so many ways that they can really, really drive up the value. And the only company that really is even coming close to them in terms of content, I think, nowadays, probably would be Netflix. They produce so many originals and get such a bang for their buck out of them. But Disney has literally a century worth of accumulated content that they can continue to leverage and monetize. So they are, in my view, the kings of content and IP. That's just my general take on it, though. Amazon may be winning in sports, which I have their stock too. Netflix maybe in originals and things like kind of niche stuff like K-dramas and such like that. But as far as blockbusters and classics, I think Disney takes the cake. Let me know in the comments below what you think, though, about Disney. Also, make sure you do all the things for the algo, the like, share, and subscribe. Follow me on Twitter at Mr. Macho Mog. I'm trying to get my first 500 followers on there, and hopefully beyond to thousands, just like here on YouTube, where I've got just over 2,000 subscribers. Thanks everybody that helped me get to that milestone. Also, catch me every Saturday at 8 p.m. Eastern, Cashflow Kings Live. And if you want to have your suggestions put to the top of the pile for what I cover next, consider becoming a channel member and talking to me on the members only post on the community page. Take it easy, everyone.